Before we begin, a quick and important disclaimer. The following presentation is intended strictly for educational and entertainment purposes and does not constitute professional financial, legal, tax, or insurance advice. The historical trends, market analyses, and case studies discussed regarding asset protection, financial safety nets, marriage, and divorce are not indicative of future results or personal outcomes. Laws regarding asset division and insurance regulations vary significantly by state and jurisdiction. Always consult with licensed legal counsel, certified financial planners, and registered insurance professionals before making any decisions regarding contracts, prenuptial agreements, insurance policies, or your personal wealth management strategy. Please conduct your own extensive due diligence before entering into any financial or legal commitment. Imagine walking into a high-end Las Vegas casino, sitting down at a high-stakes roulette table, and placing your entire net worth, your accumulated savings, your retirement accounts, the equity in your home, and potentially half of your future earning potential on a single spin of the wheel where the odds of winning are effectively a coin toss. If a fiduciary financial advisor suggested this strategy for your portfolio, they would be immediately stripped of their license and likely investigated for gross negligence. Yet, millions of Americans engage in a statistically identical risk profile every single year without a second thought. Current demographic data and historical trends indicate that a significant percentage of marriages in the United States will ultimately end in dissolution. The mainstream narrative surrounding this reality is almost exclusively focused on the emotional trauma, the familial disruption, and the psychological toll. But there is a massive, often ignored elephant in the room. The truly devastating element of a fractured marriage is not solely the emotional fallout. It is the catastrophic, systemic destruction of personal wealth. When a legal union dissolves, it triggers a uniquely destructive financial event that can wipe out decades of compounded economic growth in a matter of months. We are not merely talking about splitting the checking accounts down the middle and going separate ways. The modern American divorce is an incredibly capital-intensive legal mechanism. It involves retaining specialized family law attorneys who charge hundreds of dollars per hour, demanding massive initial retainers that immediately drain liquid cash reserves. It often requires hiring forensic accountants to meticulously trace potentially hidden assets or to properly value complex business interests, intellectual property, and diversified investment portfolios. It frequently forces the liquidation of assets at the absolute worst possible times, triggering massive capital gains taxes and severe early withdrawal penalties from tax-advantaged retirement vehicles like 401ks and traditional IRAs. Furthermore, it regularly necessitates the forced sale of the primary residence, often in unfavorable housing markets or environments of high interest rates, simply to satisfy the equitable distribution requirements mandated by state court judges. This is a multi-billion-dollar industry built entirely on the systematic dismantling and redistribution of the average American's accumulated wealth. Now, consider a fascinating paradox in human behavior and modern economic theory. If you purchase a home, you are fundamentally required by your mortgage lender to carry comprehensive homeowner's insurance. The statistical probability of your house being completely destroyed by a catastrophic fire is incredibly low, roughly a fraction of a single percent over the lifetime of a 30-year mortgage. Yet, you pay thousands of dollars in premiums year after year, without a moment of hesitation, to protect against that incredibly remote possibility. You insure your vehicle against collisions on the highway. You insure your health against unforeseen medical emergencies and exorbitant hospital bills. You insure your life to protect your dependents. You even insure your consumer electronics against accidental damage. But when it comes to the single greatest statistical threat to your financial solvency, a life event with a probability hovering near 50%, the vast majority of Americans operate completely uninsured, entirely financially exposed, and fundamentally unprotected from ruin. But what if that dynamic was fundamentally shifting beneath our feet? What if the institutional financial industry, recognizing this massive unaddressed gap in risk management, had been quietly conceptualizing and developing mechanisms to hedge against the collapse of a legal partnership? What if the long, complex evolution of financial safety nets in the United States has been slowly marching toward a highly controversial, mathematically complex, and intensely debated concept known as divorce insurance? This is not a hypothetical science fiction scenario, nor is it a fringe economic theory. To understand how such a radical financial product could even exist, we have to fundamentally rethink how we view legal partnerships in the United States. We must briefly strip away the societal romanticism and analyze marriage through the cold, objective lens of contract law, liability exposure, and economic risk mitigation. In this comprehensive masterclass, we are going deep into the historical architecture of financial safety nets in America. We will trace the fascinating evolution of how society has attempted to protect wealth against the unpredictable variables of human behavior and changing legal frameworks. By the end of this exhaustive presentation, you will possess a profound, professional-grade understanding of how asset protection has evolved over centuries. More importantly, this deep dive will solve a critical problem for you today. It will equip you with the historical context and foundational financial literacy necessary to objectively evaluate your own financial exposure. You will learn to identify the invisible vulnerabilities in your net worth that traditional financial planning often completely overlooks. We will examine the potential outcomes of historical legal precedents, dissect the earliest forms of marital asset protection, and follow the timeline straight through to the modern era of complex financial hedging. Historically, wealth was tied to agrarian land and extended family networks, which served as the primary safety net. When families transitioned to the industrial and modern service economies, wealth became liquid, portable, and inherently more vulnerable to division. We will see exactly how the systemic failures of traditional legal frameworks like permanent alimony, the inherent legal limitations and high contestability of standard prenuptial agreements, and the rapidly shifting dynamics of the dual-income American workforce have created a massive vacuum. This vacuum represents a demand for a new type of financial security. We are going to explore the actuarial mechanics, the stringent regulatory hurdles, and the deep ethical controversies surrounding the monetization of marital failure. This knowledge is paramount for anyone looking to build, protect, and sustain multigenerational wealth in an era where the legal foundations of family structures are constantly shifting. The mechanisms of wealth preservation are completely changing, and those who remain ignorant to the complex history of these financial safety nets leave themselves exposed to unprecedented financial liability. Let us begin our analysis by examining the earliest foundations of economic security in the United States, and how the initial rigid legal frameworks inadvertently set the stage for the modern financial crises that families face in the courtroom today. To truly grasp the magnitude of our current vulnerability in 2026, we have to rewind the clock and examine the architectural blueprint of early American wealth. In the 18th and 19th centuries, net worth was not measured in diversified index funds, cryptocurrency holdings, or complex derivative contracts. Wealth was tangible, geographically locked, and intrinsically tied to the agrarian ecosystem. It was measured in acres of arable land, livestock, timber, and the physical labor required to cultivate it. Marriage during this era was less of a romantic endeavor and more of a strict economic merger. It was a binding alliance between two families designed to consolidate land holdings and produce a reliable workforce. The safety net was not a financial product. It was the extended family unit itself. If a marriage failed, which was incredibly rare due to intense social and religious pressures, the economic fallout was localized. The land remained the land. It could not be easily liquidated, transferred, or divided in a courtroom by a judge. But as the United States transitioned through the Industrial Revolution and into the early 20th century, the very nature of capital began to mutate. Americans abandoned the family farm and migrated to urban centers, trading agricultural labor for factory wages, and eventually corporate salaries. Wealth transformed from immovable acreage into highly liquid, easily transferable assets. Bank accounts, corporate bonds, stock certificates, and eventually retirement pensions replaced barns and silos. Imagine a modern professional couple in 2026. Let us call them Michael and Emily. They have spent the last 15 years meticulously building a diverse portfolio consisting of employer-sponsored retirement plans, restricted stock units from a technology startup, a primary residence with substantial equity, and a high-yield savings account. Unlike the agrarian family whose wealth was essentially immune to sudden physical division, Michael and Emily possess a net worth that is entirely liquid and profoundly vulnerable to legal dissection. Their wealth is not anchored to the earth. It is suspended in digital ledgers, making it highly susceptible to equitable distribution mandates. Before we reach the modern era of Michael and Emily, we must look at the legal system's initial attempt to create a financial safety net for the vulnerable party in a separation. This mechanism was known as permanent alimony. Under the strict fault-based divorce laws of the early 20th century, ending a legal union was an incredibly high-friction event. You could not simply cite irreconcilable differences or a general lack of compatibility. You had to legally prove egregious fault, such as abandonment, extreme cruelty, or infidelity, in a court of law. The historical trends of this era reveal a system where financial protection was weaponized. If a wife could prove her husband was at fault, the court would award her permanent alimony, an indefinite stream of income designed to replicate the economic security of the marriage. This was the original, albeit highly flawed, marital insurance policy. It operated on the premise that the at-fault party must economically indemnify the innocent party for the duration of their natural life. Consider the potential outcomes of this rigid structure. Because proving fault was the only mechanism to secure financial survival or to escape the union, courtrooms became stages for elaborate, often fabricated theatrical performances. Private investigators were hired to stage evidence of infidelity. Spouses engaged in bitter, protracted litigation simply to establish blame and secure their financial future. The legal framework was fundamentally misaligned with human reality, forcing individuals to either remain in toxic environments or destroy each other in the public record to trigger the financial safety net of alimony. This system of legally mandated financial retribution became completely unsustainable. The pressure cooker finally exploded in 1969 when California enacted the nation's first no-fault divorce legislation, a legal revolution signed into law by then-Governor Ronald Reagan. Over the following decades, this legal framework swept across the United States, fundamentally altering the risk profile of the American marriage. Under no-fault laws, either party could dissolve the legal contract for any reason, at any time, without proving any wrongdoing whatsoever. While hailed as a massive leap forward for personal autonomy and social progress, no-fault divorce inadvertently destroyed the traditional financial safety net. The historical precedent of permanent alimony began to rapidly erode. Courts shifted their focus from lifelong financial support to temporary, rehabilitative alimony, designed only to support the lesser-earning spouse until they could re-enter the workforce. This legal paradigm shift created a massive systemic vacuum in asset protection. Suddenly, the liquidation and division of hard-earned assets became the primary focus of the dissolution process. The courts were no longer tasked with punishing the guilty and protecting the innocent. They were tasked with the ruthless mathematical division of the marital estate. Let us analyze the step-by-step details of this modern financial dissection. When a union dissolves today, the legal system employs complex formulas to determine what constitutes separate property versus marital property. In community property states, the wealth generated during the marriage is generally cleaved violently in half, regardless of who primarily earned the income. In equitable distribution states, judges possess sweeping discretionary power to divide assets fairly, which rarely translates to equally. This introduces a terrifying level of unpredictability. A single judge applying subjective legal standards has the authority to dictate the liquidation of a business, the forced sale of a family home, and the massive reallocation of retirement accounts. Take the division of a standard 401k as a prime example of this wealth destruction. To legally divide a retirement account without triggering immediate, massive tax penalties, the court must issue a specific legal document known as a Qualified Domestic Relations Order. Drafting and executing this single document requires specialized attorneys and administrators, instantly draining thousands of dollars from the marital estate before a single cent is even transferred. Once executed, decades of carefully calibrated compound interest are instantly halved, completely destroying the long-term yield projections of the original portfolio. As the reality of this unprecedented financial exposure dawned on high net worth individuals in the late 20th century, they demanded a new mechanism to protect their capital from the unpredictable rulings of family court judges. They needed a legal shield, a preemptive contract to override the default state laws of equitable distribution. This demand birthed the modern era of the prenuptial agreement, a tool that functioned as the next evolutionary step in financial safety nets. But as we are about to see, this legal barrier was structurally flawed from the very beginning, full of hidden trapdoors, and ultimately failed to protect the very wealth it was designed to guard, leaving millions completely exposed to a financial catastrophe they never saw coming. The fundamental flaw in the American public's understanding of a prenuptial agreement is the dangerous assumption that it functions as an impenetrable financial vault. In reality, a prenup is nothing more than a highly contestable, privately negotiated contract drafted between two fiduciaries. And like any contract in the United States legal system, it is subject to interpretation, subjective judicial review, and aggressive invalidation. The mainstream media often portrays prenups as the ultimate financial safety net for the ultra-wealthy, a magical piece of paper that instantly deflects any courtroom attack. But historical trends and decades of family law precedents reveal a shockingly different potential outcome. A prenuptial agreement is incredibly fragile. It can be completely dismantled by a skilled attorney using a variety of standard legal crowbars, rendering the entire document useless when you need it most. To understand how this happens, we must examine the specific legal trapdoors built into these agreements. The first and most common mechanism for destroying a prenuptial agreement is proving a failure of full financial disclosure. For a prenup to hold up in court, both parties must completely and accurately reveal every single asset, liability, and stream of income prior to signing. Imagine a scenario where an entrepreneur attempts to protect their startup equity, but intentionally undervalues the company or forgets to list a secondary offshore brokerage account. If the marriage dissolves 5 years later, a specialized forensic accountant will be retained to audit the estate. They will comb through years of bank statements, tax returns, and digital transaction logs to trace the origin of every dollar. They will actively look for discrepancies between reported lifestyle expenses and actual declared income. If they uncover that hidden asset, or prove that a spouse intentionally parked funds in an irrevocable trust just weeks before signing without proper disclosure, the judge has the discretionary power to throw the entire agreement out the window, citing fraudulent inducement. The protective shield vanishes instantly, and the entire marital estate is thrown back into the chaotic blender of state-mandated, equitable distribution. But even if disclosure is absolutely perfect, the agreement faces the terrifying and unpredictable threat of unconscionability. Family courts in the United States operate under a fundamental mandate of equity and fairness. If a judge looks at a prenuptial agreement signed a decade ago and determines that enforcing it today would leave one spouse entirely destitute and reliant on public assistance, while the other walks away with millions, the judge can legally refuse to enforce the contract. They can simply declare the terms unconscionable based on the present-day circumstances, regardless of what was agreed upon in the past. This means your financial safety net is completely dependent on the subjective moral compass and legal interpretation of a single individual sitting behind a bench on any given Tuesday. Let us look at a practical case study taking place right now in 2026. Consider David and Sarah. David entered the marriage with a lucrative portfolio of commercial real estate. He wisely hired a top-tier law firm to draft an ironclad prenuptial agreement stating that all premarital real estate and its future appreciation would remain his sole and separate property. Fast forward 7 years. The marriage is failing. David believes his real estate empire is perfectly safe. However, during the marriage, David casually used a joint checking account, where both his and Sarah's paychecks were deposited, to occasionally pay the property taxes and fund routine maintenance on those commercial buildings. This incredibly common, seemingly harmless administrative mistake triggers a catastrophic legal concept known as commingling. By using marital funds, even just a few $1,000s, to maintain his separate property, David inadvertently hybridized the asset. Sarah's attorney will immediately argue that her income directly contributed to the preservation and appreciation of the real estate. The clear lines of the prenuptial agreement are instantly blurred. A judge will likely rule that the commercial properties are no longer strictly separate, forcing David into a brutal settlement where he must liquidate a portion of his premarital empire to buy out Sarah's newly acquired equitable interest. The prenup failed not because it was poorly written, but because the daily, practical reality of marriage makes strict financial segregation almost impossible to maintain over long periods of time. Furthermore, the very act of creating a prenuptial agreement introduces massive psychological friction into the relationship before it even begins. It forces a couple actively planning a lifelong union to sit across a mahogany table with opposing legal counsel and aggressively negotiate the exact terms of their future failure. It mandates a fundamentally adversarial posture during a period supposed to be built on absolute trust and mutual partnership. Because of this intense emotional toll, historical data shows that only a tiny fraction of the United States public actually executes these agreements. For the vast majority of middle and upper middle class Americans, the emotional cost is simply too high, leaving them entirely exposed to default state laws. Some couples attempt to rectify this lack of protection later in the marriage through a postnuptial agreement, usually drafted when a business suddenly takes off or an unexpected inheritance is received. But postnups are mathematically and legally even weaker than prenups. Because the parties are already married, they owe each other the highest level of fiduciary duty. Any contract that seemingly benefits one spouse at the expense of the other is viewed by the courts with extreme suspicion. Judges frequently invalidate postnuptial agreements under the presumption of undue influence or coercion, making them a profoundly unreliable financial safety net. As we analyze the current economic landscape of 2026, the complexity of asset protection has exponentially multiplied. We are no longer dealing with the single breadwinner households of the 1950s or 1960s. The modern American marriage is a complex merger of two highly active financial lives. Consider the advent of the gig economy, decentralized finance, and remote work, variables that simply did not exist a few decades ago. Both partners likely possess 401ks, competing corporate benefits, restricted stock units that vest on rolling schedules, fractional real estate investments, and potentially crushing, varying levels of student loan debt. Disentangling this dual income architecture using the blunt instrument of a prenuptial agreement is like trying to perform delicate neurosurgery with a sledgehammer. The legal fees required just to defend a prenup in court can easily decimate the liquid assets of both parties, turning the divorce process into a financial war of attrition where the only true victors are the hourly billing attorneys. By the early 2000s, the highest levels of the financial sector began to recognize this massive, gaping hole in the market. Wealth managers and institutional investors saw millions of clients actively bleeding capital through a legal system that contracts simply could not tame. They realized a fundamental truth: you cannot litigate your way out of statistical risk. If a legal contract is too fragile, too expensive to defend, and too emotionally damaging to initiate, you have to abandon the legal framework entirely. You have to turn to the only industry built entirely on the monetization and mitigation of human catastrophe. You have to turn to the actuaries. But how exactly do you calculate the statistical probability of a broken heart? And more importantly, how do you convince Wall Street to underwrite the single most volatile asset in the world? To answer that, we must enter the highly secretive, mathematically rigorous world of the actuarial sciences. Actuaries are essentially the architects of financial reality. Their entire profession is dedicated to translating human chaos, natural disasters, and statistical anomalies into cold, hard, predictable probabilities. Historically, actuaries built their sophisticated models around tangible, easily quantifiable events. They calculated the mortality rates of specific demographics to price life insurance. They analyzed the historical frequency of hurricanes in coastal zip codes to underwrite property insurance. They mapped the statistical likelihood of vehicular collisions based on the age and gender of drivers to structure auto policies. But applying these rigid mathematical frameworks to the intensely private, emotionally volatile, and fundamentally unpredictable realm of human relationships was an entirely unprecedented challenge. To even begin conceptualizing a financial product that could hedge against marital dissolution, actuaries had to completely strip away the societal romanticism of marriage. They had to view a legal union not as a sacred bond, but as a standard corporate merger possessing a documented, remarkably high historical failure rate. The first step in this monumental task was building a completely new type of risk assessment tool. They could not rely on standard mortality tables. Instead, financial engineers had to invent what we can conceptualize as a marital dissolution table. This required ingesting massive, localized datasets regarding demographic behavior across the United States. Analysts began isolating the specific variables that heavily correlated with the potential outcomes of a divorce. They looked at the age of both individuals at the time of the first marriage, their respective levels of educational attainment, their geographical location, and significantly, the historical stability of their individual credit scores. The historical trends revealed distinct danger zones. Statistical data indicated that marriages were exceptionally vulnerable during specific chronological windows, such as years 3 through 7, and again when couples entered the empty nest phase after children left the primary residence. By mapping these demographic pressure points, actuaries began to see a predictable mathematical shape to the risk. However, the moment Wall Street attempted to translate these early mathematical models into a viable consumer product, they immediately crashed into the twin demons of the insurance industry. The first and most lethal of these institutional roadblocks is a concept known as adverse selection. Imagine if an insurance company offered a highly lucrative fire insurance policy, but the only people rushing to purchase the coverage were homeowners who currently smelled smoke in their living rooms. This was the fundamental crisis facing the earliest iterations of divorce insurance. The institutional fear was that the only consumers who would actively seek out and pay premiums for this specific financial safety net were individuals who secretly knew their marriage was already in terminal decline. If a provider only insures burning houses, the risk pool collapses immediately, and the financial reserves are entirely decimated within the first few years of operation. To observe how the industry attempted to navigate this, let us look at a foundational case study of early product structuring, leading to the sophisticated models we see actively discussed in the 2026 financial landscape. Let us imagine an underwriter named Richard working for a boutique risk management firm in the early 2000s. Richard understood that to defeat adverse selection, you could not simply issue a policy on demand. He proposed a structure that mandated a strict, non-negotiable incubation period. In this theoretical model, an individual could purchase the policy, but a critical legal mechanism was embedded within the contract stating that no claim could be filed, and no payout would be triggered if the legal dissolution of the marriage occurred within the first 48 to 72 months following the policy origination date. If the marriage failed within that initial window, the policyholder would merely receive a refund of their raw premiums, minus a heavy administrative penalty fee, yielding absolutely zero protective financial benefit. This multi-year incubation period acted as a structural firewall. It forced the consumer to financially commit to the policy long before any actual marital distress was visible on the horizon, thereby artificially filtering out the high-risk applicants looking for a quick bailout. But even with the incubation period solving the adverse selection crisis, Richard and his institutional colleagues faced a second, deeply controversial obstacle known as moral hazard. Moral hazard occurs when a party is protected from risk, and as a direct result, fundamentally alters their behavior to act more recklessly than they normally would. In the context of our deep dive, the implications were terrifying to traditional underwriters. The argument was simple but profound. If a husband or wife knows they possess a guaranteed, multi-million-dollar financial safety net that immediately triggers upon the signing of a divorce decree, the economic incentive to endure the inevitable difficult periods of a long-term relationship completely evaporates. Financial analysts actively debated whether the sheer existence of the insurance policy would inadvertently cause a massive spike in the actual occurrence of the event it was designed to protect against. It threatened to become a self-fulfilling financial prophecy where the cure actually amplified the disease. Overcoming this required a masterclass in financial engineering. To neutralize moral hazard, the payout structure of the policy had to be drastically reimagined. It could not operate like a winning lottery ticket. The policy could not make the individual wealthy upon separation. It could only serve to prevent them from becoming completely economically destitute. The architects realized the payout had to be strictly structured as an indemnification. Step by step, the mechanics were refined so that the eventual capital deployment was mathematically pegged to specific, verifiable expenses. The funds would be heavily restricted, designated exclusively to cover the exorbitant retainers of family law attorneys, the hourly billing of forensic accountants, the penalties incurred from the early liquidation of 401k accounts, and the direct, quantifiable loss of the individual's primary residence equity. This brings us to the operational mechanics of how such a policy functions in the modern era. The underwriting process evolved to require an unprecedented level of personal intrusion. Purchasing this type of liability hedging requires extensive background checks, pulling localized economic data, analyzing the long-term career trajectories of both spouses, and evaluating the overall liquidity of the marital estate. The monthly premium calculated by the underwriter is dynamically correlated to the perceived instability of the demographic cohort you belong to. It is a highly localized, hyper-specific evaluation of your personal financial vulnerability. Yet, despite solving the mathematical equations of adverse selection and moral hazard, traditional insurance conglomerates were absolutely terrified of the impending public relations nightmare. The United States public historically views the overt monetization of heartbreak and family dissolution as deeply unethical. The idea of profiting from a collapsed household triggered massive institutional hesitation. Consequently, the early pioneers of this financial instrument realized they had to completely obscure the true nature of the product. They realized they could never market it directly as divorce insurance. They had to mask the entire operation behind the sterile, complex, corporate vocabulary of contractual asset protection, marital liability hedging, and prenuptial indemnity riders. So the actuarial models were successfully built. The mathematical risk was cleanly isolated. The structural incubation periods were firmly established to protect the underwriters. But transforming a mathematically sound, yet morally controversial financial derivative from a whiteboard concept into an actual retail product required navigating a brutal labyrinth of federal and state regulations. It required engaging in outright warfare against state insurance commissioners, who viewed the very existence of the product as a fundamental violation of public policy. And as the very first company boldly attempted to launch this radical financial safety net to the American public, they immediately triggered a catastrophic collision with the legal system, a regulatory bloodbath that threatened to completely destroy the entire industry before a single policy was ever successfully paid out. To understand the sheer scale of this regulatory bloodbath, you must first understand a fundamental, often misunderstood quirk of the United States financial system. Unlike the trading of publicly listed stocks and corporate bonds, which is governed at the federal level by the Securities and Exchange Commission, the insurance industry possesses no single, unified national regulatory body. Instead, through historical legal precedents dating back to the mid-20th century, the authority to regulate insurance was entirely delegated to the individual states. This means there are 50 separate state insurance commissioners, operating 50 independent regulatory fiefdoms, each with its own massive legal code, specific capital reserve requirements, and intensely political appointed officials. For an institutional underwriter attempting to launch a radically unprecedented financial product like marital liability hedging, they could not simply get one stamp of approval in Washington, D.C. They had to fight 50 separate, grueling ground wars across the country, convincing 50 different bureaucratic bodies that monetizing the dissolution of a family was a legitimate financial enterprise. The primary legal weapon these state regulators immediately deployed to block these early filings was an ancient tenet of contract law, known as the void against public policy doctrine. In the United States legal system, a contract can be perfectly drafted, mathematically sound, and completely voluntary between two parties. But if a judge or regulator determines that the underlying nature of the contract is fundamentally harmful to the general welfare of society, they can declare it completely void and illegal to enforce. Historically, the preservation of the family unit and the institution of marriage has been viewed by the courts as a cornerstone of social stability and public policy. When the first ambitious underwriters walked into state regulatory offices and presented their incredibly detailed actuarial tables for divorce insurance, the commissioners were universally appalled. The regulatory bodies argued vehemently that allowing a corporation to provide a massive, liquid financial payout upon the signing of a divorce decree actively incentivized the destruction of that core social institution. They viewed it not as a safety net, but as an institutional bounty placed on the American family. Facing immediate rejection and the threat of permanent bans, the legal teams backing these early financial pioneers had to execute a massive structural pivot in how they categorized the risk. They realized they could never achieve regulatory approval if they pitched the product as insurance against a broken marriage. They had to completely reframe the narrative, forcing the regulators to look at the product through the sterile lens of casualty insurance and legal liability. Their argument shifted away from the emotional event and focused entirely on the severe, quantifiable financial damages mandated by the state court systems. They argued to the regulators that they were not ensuring the emotional failure of the relationship. Rather, they were providing a specialized legal defense fund to protect citizens from the catastrophic asset liquidation naturally triggered by the state's own equitable distribution laws. They attempted to categorize the policy alongside standard directors' and officers' liability insurance, or professional malpractice coverage. They were simply insuring against an unavoidable legal catastrophe. Imagine a critical turning point scenario looking back from our current vantage point in 2026. Let us examine the historical trends of a fictionalized pioneer CEO, a man named Robert, who represented one of these early risk management startups. Robert found himself standing before a highly hostile regulatory board in a stringent jurisdiction like New York or California. The state commissioner aggressively challenged him, asserting that his product transformed the sacred bond of marriage into a shortable stock, allowing individuals to actively bet against their own personal success. Robert countered with brutal mathematical reality. He presented extensive case studies and demographic data demonstrating that roughly half of all unions were already collapsing, entirely independent of any financial product. He argued that by blocking this specialized casualty insurance, the state was actively forcing millions of Americans into unavoidable bankruptcy, foreclosures, and massive tax penalties simply because they lacked the liquid capital to properly navigate the complex family court system. Robert's position was that the state was protecting a philosophical ideal, while completely ignoring a systemic, multi-billion-dollar financial crisis happening in their own courtrooms every single day. To achieve even a fraction of a compromise with these highly skeptical regulatory boards, the The early architects of this industry were forced to implement brutal mathematical concessions into the core structure of the policies. Beyond the multi-year incubation periods we previously discussed, state commissioners mandated the integration of aggressive co-insurance requirements and massive deductibles. A regulator would argue that if the policy covered 100% of a person's legal fees and asset losses, the individual would have absolutely no incentive to mediate, compromise, or settle the dispute peacefully. They would simply hire the most expensive, aggressive litigation attorneys available and fight a scorched earth campaign funded entirely by the underwriter. To prevent this scenario, the policies were strictly rewritten. If a policyholder incurred $100,000 in specialized legal fees and forensic accounting costs, the insurance would only cover perhaps 60% of that specific sum. The policyholder was legally forced to pay the remaining 40% out of their own depleted pockets. This mandated financial pain was intentionally designed by the state regulators to ensure the consumer maintained a severe vested interest in keeping the overall costs of the legal dissolution as low as possible. Despite these massive structural compromises, despite the brilliant reframing of the product as legal casualty insurance, and despite winning isolated, grueling victories in a handful of less regulated states, the direct-to-consumer market for marital liability hedging was fundamentally gridlocked. The industry was burning through tens of millions of dollars in venture capital, just paying lobbying fees and legal retainers to fight the state commissioners. Furthermore, the marketing challenge was insurmountable. Selling a policy directly to an individual consumer like Michael or Emily required them to actively click a button and admit they were preparing for the catastrophic failure of their own household, a psychological barrier that proved almost impossible to scale. The institutional architects backing these products realized they were fighting a losing war of attrition. The state-by-state regulatory battle was too slow, and the direct consumer acquisition cost was astronomically high. To survive, they had to completely abandon the individual retail market. They needed a totally different mechanism to bypass the moral stigma, circumvent the intense individual underwriting process, and instantly access millions of covered lives at once without the consumer ever having to consciously admit their marriage might fail. They needed a financial Trojan horse, and they found it hiding in plain sight within the absolute last place anyone would ever expect: the highly structured, deeply entrenched world of corporate America and the modern employee benefits package. To understand why the institutional underwriters pivoted so aggressively away from the individual consumer market, you have to analyze the fundamental mathematical architecture of group risk. In the insurance industry, selling a standalone policy to a single individual is a dangerous, unpredictable gamble, heavily skewed by adverse selection. However, when an underwriter approaches a major multinational corporation and secures a contract to insure 10,000, 50,000, or 100,000 employees simultaneously, the entire risk profile fundamentally transforms. This is driven by a statistical concept known as the law of large numbers. In a massive corporate pool, the underwriter no longer cares about the specific marital stability of one single employee. They know, based on decades of historical trends and macro-demographic data, that exactly a certain percentage of that specific workforce will undergo a legal separation in any given calendar year. The vast majority of the employees will pay their monthly premiums and never utilize the benefit, effectively subsidizing the inevitable legal catastrophes of the minority. Imagine a mid-level software engineer named James working for a massive, publicly traded logistics corporation in the year 2026. It is November, the standard window for corporate open enrollment. James logs into his human resources digital portal to select his benefits for the upcoming fiscal year. Right beneath his standard medical, dental, and vision coverage, alongside the options for supplemental life insurance and pet care benefits, there is a completely unassuming checkbox labeled Comprehensive Legal Casualty and Asset Protection. The monthly premium is a negligible $35, completely subsidized if he selects the high-deductible tier. James does not have to sit in a sterile office, look an agent in the eye, and admit his marriage might be slowly deteriorating. He does not have to actively confront the terrifying statistical probability of a future divorce. He simply clicks a box during a routine administrative task, viewing it as just another standard layer of responsible adult financial planning. The immense moral stigma that completely crippled the direct-to-consumer market vanishes instantly within the mundane bureaucracy of corporate human resources. Furthermore, the mechanics of how this premium is collected represent a masterclass in behavioral economics. Because the cost of the policy is automatically extracted via pre-tax payroll deduction, the friction of the transaction is entirely eliminated. James never actually sees that $35 hit his checking account, so he never feels the psychological pain of spending it. It becomes invisible money, silently funding a massive latent safety net over years of employment. This automated, frictionless capital extraction allowed the underwriters to finally build the massive, stable financial reserves required to actually support the payouts when the legal claims inevitably rolled in. But a critical question remains. Why would a modern corporate human resources department actively choose to integrate marital liability hedging into their benefits package? The answer has absolutely nothing to do with corporate empathy or a desire to protect the personal wealth of their workforce. It is driven entirely by cold, calculated corporate productivity metrics and a ruthless defense of the bottom line. Extensive historical trends and internal corporate data analytics demonstrate that a divorcing employee is a profound financial liability to the company. When an individual is navigating the brutal labyrinth of the family court system, their cognitive bandwidth is entirely consumed by the crisis. They are taking highly emotional calls from their legal counsel in the middle of the workday. They are burning through their accrued paid time off to attend mandatory mediation sessions and grueling court hearings. They are operating under immense psychological distress, terrified of forced home sales and the liquidation of their retirement assets, which leads directly to severe presenteeism. The employee is physically sitting at their desk, but their mental output and professional efficacy are virtually zero. Corporate analysts quantified this massive loss in productivity and realized it was costing Fortune 500 companies billions of dollars annually in delayed projects, increased error rates, and necessary temporary staffing. By providing a financial safety net that specifically covers the exorbitant legal retainers and forensic accounting fees, the corporation actively expedites the dissolution process. The policy often requires the employee to utilize a specific, pre-vetted network of highly efficient attorneys and specialized mediators who are contractually obligated to resolve the dispute as quickly as possible, avoiding protracted, multi-year litigation. The underlying corporate objective is to brutally stabilize the employee's personal life, protect them from immediate financial ruin, and get their undivided cognitive focus back on their corporate deliverables as rapidly as mathematically possible. It is not an employee benefit. It is a corporate retention and productivity tool masquerading as a financial safety net. This strategic reframing as a corporate productivity tool also provided the institutional underwriters with the ultimate weapon to bypass the state insurance commissioners who had previously blocked the product. Under the complex architecture of the United States legal system, specifically the Employee Retirement Income Security Act, employer-sponsored welfare benefit plans often fall under federal jurisdiction, preempting a massive amount of state-level interference. While the underwriters still had to navigate complex regulatory filings, the states simply could not utilize the void against public policy argument with the same devastating effectiveness. Regulators found it nearly impossible to block a Fortune 500 company from voluntarily offering a heavily subsidized legal defense fund to its own employees, especially when the corporation presented hard data proving the benefit actively protected the mental health and economic stability of the local workforce. The regulatory bloodbath that destroyed the retail market was bypassed entirely through the sheer lobbying power and legal arbitrage of corporate America. By successfully embedding this controversial financial product deep within the American corporate infrastructure, the underwriters achieved unprecedented scale. Millions of workers in 2026 are completely unaware that their standard corporate legal plan now contains sophisticated riders designed specifically to hedge against the collapse of their household. The industry finally solved the adverse selection crisis, bypassed the moral stigma, and outmaneuvered the state regulators. It appeared to be a flawless execution of financial engineering. However, in their aggressive rush to scale the product through employer channels, the architects of this system failed to anticipate a massive, catastrophic structural flaw. By permanently tethering the ultimate personal financial safety net to the whims of corporate employment, they inadvertently created an entirely new, deeply terrifying vulnerability. What happens to that multi-million-dollar protective shield when the broader macroeconomic environment shifts, the tech bubble bursts, and the corporation decides to ruthlessly downsize the very workforce it promised to protect? The answer to that question exposes the most devastating structural flaw in the entire employer-sponsored asset protection model. When you tether a fundamental financial safety net to corporate employment, you create a terrifying paradox. Historical trends and massive volumes of sociological data demonstrate that the single greatest catalyst for marital dissolution is sudden, severe financial stress. The loss of a primary income stream, the evaporation of a career identity, and the rapid depletion of liquid savings act as an absolute accelerant for household instability. Therefore, the exact macroeconomic event that triggers the collapse of the marriage is the exact same event that completely strips the employee of their legal defense fund. The umbrella is violently yanked away at the precise millisecond it starts to pour. To understand the catastrophic potential outcomes of this systemic design flaw, we must analyze a hyper-realistic case study unfolding in the current economic landscape of 2026. Imagine a highly compensated professional named Sarah. Sarah is a senior logistics director living in a major metropolitan hub. For the past 5 years, she has diligently opted into her Fortune 500 company's comprehensive legal casualty and asset protection plan. She views this pre-tax payroll deduction as a highly responsible, invisible shield protecting the substantial equity she has built in her primary residence and her heavily concentrated tech portfolio. However, the macroeconomic environment shifts. The Federal Reserve maintains aggressive monetary tightening, consumer spending contracts, and Sarah's corporation initiates a sudden 20% global workforce reduction to protect shareholder yield. On a mundane Tuesday morning, Sarah is terminated. The human resources offboarding process is swift and clinical. While she is provided a standard severance package, the fine print regarding her secondary benefits is brutal. Unlike her health insurance, which falls under specific federal continuity laws, her legal casualty policy possesses a strict, immediate termination clause. The moment she is no longer an active payroll employee, the multi-million-dollar protective shield completely vaporizes. This creates a compounding financial trauma. The sudden loss of Sarah's high six-figure salary introduces immense pressure into an already fragile marriage. Within 90 days of the layoff, the household tension reaches a breaking point, and her spouse files for dissolution. Sarah is now facing the exact legal catastrophe she paid premiums for half a decade to avoid, but she is facing it entirely uninsured. The severance capital she desperately needs to survive her unemployment must now be instantly redirected to pay a $50,000 initial retainer to a family law attorney. Furthermore, because her corporate stock options are now frozen or heavily penalized due to her termination, her liquid net worth is at its lowest possible point in 10 years. She is forced to negotiate the division of her life entirely from a position of profound financial weakness. The corporate safety net she relied upon was not a permanent asset, it was a conditional illusion, entirely dependent on her continued economic utility to a massive corporation. When financial analysts and wealth managers began observing these exact scenarios playing out across the economy, a massive wave of panic rippled through the sector. The immediate question raised by consumer advocacy groups was why these legal casualty policies could not simply be extended post-employment. Why could employees not utilize the Consolidated Omnibus Budget Reconciliation Act, universally known as COBRA, to maintain their marital insurance by simply paying the full premium out of pocket, exactly as they do with their medical, dental, and vision coverage? The answer reveals the ruthless, calculated genius of the institutional actuaries. When the insurance conglomerates originally lobbied to integrate these products into corporate benefit packages, they explicitly designed the contracts to circumvent COBRA eligibility. Federal historical trends show that COBRA mandates the continuation of healthcare benefits, but it does not mandate the continuation of highly specialized property and casualty or legal indemnification riders. The actuaries intentionally categorized the product to ensure it fell outside federal continuation protections. They did this because they were absolutely terrified of the adverse selection trap returning. If an employee knew their marriage was failing precisely because they just lost their job, they would gladly pay an exorbitant out-of-pocket premium to keep the legal defense fund active. The insurance companies would suddenly be flooded with claims from highly distressed, unemployed individuals, instantly destroying the profitability of the corporate risk pool. To protect their margins, the underwriters built an automated trapdoor. The policy must sever immediately upon job loss, effectively abandoning the consumer at their absolute maximum point of vulnerability. As the reality of this corporate trap became widely understood among high-net-worth individuals, entrepreneurs, and independent contractors who never had access to employer-sponsored plans anyway, the demand for a permanent, untethered financial safety net reached a fever pitch. Wealthy Americans realized a fundamental truth about risk management. You cannot rely on a third-party underwriter who possesses the legal authority to cancel your policy, change your premiums, or deny your claim based on a technicality. True financial security could not be rented on a monthly basis from an insurance conglomerate or a corporate employer. It had to be owned outright. It had to be self-funded. This profound realization triggered the next massive evolutionary leap in the history of American asset protection. Wealth managers, forensic accountants, and specialized estate planning attorneys began completely abandoning the traditional insurance markets. They stopped trying to mathematically calculate the statistical probability of a divorce and shifted their focus entirely to making the marital estate functionally impossible to divide. They moved away from the concept of indemnification and embraced the concept of absolute financial privatization. To achieve this, the highest tiers of the financial sector began resurrecting and aggressively modifying ancient legal structures originally designed for dynastic wealth transfer and international tax sheltering. They sought a mechanism that could legally strip the individual of their own ownership, transferring the title of their assets into a hyper-secure, legally recognized vault that even a state family court judge could not penetrate. This required stepping into a highly complex, fiercely debated, and heavily scrutinized area of law. We are moving beyond simple contracts and entering the realm of autonomous legal entities. We must examine the precise, step-by-step mechanics of how an individual can purposefully impoverish themselves on paper while retaining complete, dictatorial control over millions of dollars in liquid capital. But executing this strategy requires navigating a terrifying legal minefield, because if you move your assets even one day too late, the federal government will classify your safety net as a criminal act of fraudulent conveyance. The doctrine of fraudulent conveyance is the legal system's ultimate countermeasure against panicked financial restructuring. It operates on a brutally simple premise, established over centuries of common law. You cannot intentionally transfer, gift, or hide an asset with the specific intent to hinder, delay, or defraud a current or future creditor. In the hyper-aggressive environment of American family law, a divorcing spouse is legally classified as the ultimate creditor. When a relationship begins to critically fracture, the natural human instinct is absolute self-preservation. Individuals suddenly attempt to move liquid capital into opaque cryptocurrency wallets, transfer the deeds of lucrative real estate to trusted siblings, or funnel corporate profits into newly formed, anonymous shell companies. They believe they are cleverly securing their financial survival, but forensic accountants and seasoned family law attorneys actively hunt for these exact maneuvers. They utilize a legal framework known as the badges of fraud. These badges are specific, quantifiable behaviors that automatically signal to a judge that an illicit financial transfer has occurred. Historical trends demonstrate that courts actively look for transfers made shortly before a divorce filing, transfers where the individual received nothing of equivalent value in return, or scenarios where the individual legally gave an asset away but somehow retained physical control or enjoyment of it. Consider a realistic scenario unfolding in the current economic landscape of 2026. Imagine a commercial real estate developer named Marcus. Marcus manages a portfolio of highly leveraged properties in Texas. He senses an impending catastrophic failure of his marriage. In a desperate attempt to protect a newly acquired multi-million-dollar commercial plaza from equitable distribution, he quietly transfers the deed of the property to an irrevocable trust controlled entirely by his college roommate. He receives zero financial compensation for this transfer. 6 months later, the divorce proceedings begin. Marcus confidently declares his net worth, intentionally omitting the commercial plaza because he technically no longer owns it. This is where the trap brutally snaps shut. During the mandatory financial discovery phase, his spouse's legal team subpoenas years of banking records and property titles. The forensic accountant instantly identifies the massive, uncompensated transfer. They present this evidence to the judge, highlighting the badges of fraud. The potential outcomes of this scenario are financially devastating. The judge possesses the absolute discretionary power to completely reverse the transaction, dragging the commercial plaza aggressively back into the marital estate. But the punishment rarely stops there. Because Marcus committed an intentional act of financial deception, the judge will heavily penalize him, often awarding the entire value of the hidden asset to the spouse, forcing Marcus to pay all opposing legal fees, and potentially referring the case for separate criminal perjury charges. The very mechanism Marcus used to protect his wealth became the exact instrument of his financial execution. Wealth managers and elite estate planning attorneys realize that attempting to build a financial safety net during the chaotic collapse of a household is mathematically and legally impossible. To survive strict judicial scrutiny, the protective architecture must be completely constructed, funded, and sealed during peacetime, long before any marital distress is even remotely conceivable. the legal structure must be given years to properly season. This requirement birthed a radical evolution in wealth preservation strategy, leading the ultra-wealthy away from traditional insurance products and toward highly specialized, autonomous legal entities known as domestic asset protection trusts. To understand how these powerful entities function, we must examine a fascinating shift in the United States financial ecosystem. In the late 1990s and early 2000s, several states recognized a massive economic opportunity. They realized they could attract billions of dollars in highly managed capital, generating massive tax revenues and administrative fees, if they offered affluent individuals unprecedented legal shields against creditors and divorcing spouses. States like Nevada, South Dakota, and Delaware aggressively rewrote their trust and equity codes, competing fiercely to become the premier asset protection jurisdictions in the country. The mechanics of a domestic asset protection trust are a masterclass in legal separation. When you utilize this structure, you, the grantor, take your highly appreciated technology stock, your venture capital investments, or your liquid cash, and you legally transfer the absolute ownership of those assets to the trust. You appoint an institutional trustee, which is typically a heavily regulated, state charter bank or specialized trust company located physically within that specific protective state, such as South Dakota. The critical legal distinction is that you no longer own the assets. The autonomous legal entity of the trust owns them. However, the genius of the architecture is that you are simultaneously listed as a discretionary beneficiary. This means the institutional trustee possesses the absolute, unchecked power to distribute funds to you if you require capital to maintain your lifestyle or pursue new business ventures. But if a catastrophic legal event occurs, such as a high-stakes divorce, the protective wall instantly hardens. Imagine a case study involving a highly specialized neurosurgeon named Elena living in New York in 2026. Recognizing the extreme liability of her profession and the statistical probability of marital failure, Elena establishes a Nevada domestic asset protection trust 5 years before she ever meets her future husband. She legally transfers her massive, accumulated investment portfolio into this Nevada entity. She marries, and 7 years later, the marriage dissolves in a New York family court. Her husband's aggressive legal counsel attempts to claim 50% of her accumulated portfolio, arguing it was commingled or appreciated during the marriage. The New York attorneys immediately issue a subpoena to the Nevada Trust Company, demanding the liquidation and transfer of the assets. The Nevada trustee simply refuses to comply. They respond by pointing directly to Nevada state law, which strictly prohibits the institutional trustee from distributing any trust assets to satisfy the claims of an ex-spouse or a family court judgment originating from another state. Because Elena legally gave away the ownership of the portfolio years before the marriage even existed, there is no fraudulent conveyance. She literally does not own the money. Her husband is attempting to sue an entity that possesses absolute legal immunity from his claims. The financial safety net holds perfectly. But as the usage of these domestic trusts skyrocketed among high-net-worth demographics, the opposing legal industry adapted with terrifying speed. They discovered a massive, glaring vulnerability hiding in plain sight within the foundation of the United States legal system. The Achilles heel of the domestic strategy is the full faith and credit clause of the United States Constitution, which explicitly mandates that individual states must respect and enforce the valid judicial proceedings of other states. If Elena is sitting in a New York courtroom, the New York judge might not be able to force the Nevada trustee to release the funds, but the judge possesses absolute, terrifying jurisdiction over Elena herself. The judge can look directly at Elena and issue a binding court order demanding that she use her power as a beneficiary to request a distribution from the Nevada trust to pay her husband. If Elena looks at the judge and refuses, or if she asks the trustee and the trustee denies the request, the New York judge can immediately hold Elena in civil contempt of court. In the United States, civil contempt is not a monetary fine. It is indefinite incarceration. The judge can physically order Elena to be locked in a county jail cell until she magically produces the millions of dollars currently shielded behind the Nevada trust wall. This created a brutal legal paradox where individuals successfully protected their money, but lost their physical freedom. The wealthiest families in America realized that as long as their safety nets remained within the borders of the United States, they were fundamentally vulnerable to the overlapping jurisdictions of hostile state judges. To achieve absolute, impenetrable financial privatization, they had to completely sever ties with the American judicial system and move their wealth into the most controversial, heavily scrutinized offshore jurisdictions on the planet. When the full faith and credit clause of the United States Constitution became the ultimate weapon for family law attorneys to dismantle domestic trusts, the ultra-wealthy recognized a fundamental geographic and legal reality. A United States family court judge, regardless of their authority, reputation, or aggressive interpretation of equitable distribution laws, only possesses absolute power within the sovereign borders of the United States. If an individual shifts the legal ownership of their highly appreciated capital to a sovereign foreign nation, specifically a nation that legally and constitutionally refuses to recognize the judicial rulings of American courtrooms, the jurisdictional power of that American judge immediately drops to zero. This profound realization birthed the era of the Offshore Asset Protection Trust, a financial vehicle so robust, mathematically complex, and highly scrutinized that it fundamentally changed the landscape of global wealth preservation and marital liability hedging. We are not talking about standard, antiquated Swiss bank accounts, which historical trends heavily demonstrate have completely capitulated to United States federal regulatory pressure and transparency mandates over the last 2 decades. We are examining specific, highly specialized jurisdictions like the Cook Islands, a self-governing nation in the South Pacific, or the Caribbean island of Nevis. These specific jurisdictions observed the massive wealth destruction occurring within the American legal system and actively built their entire macroeconomic infrastructure around offering impenetrable legal shields to foreign capital. In the 1980s, the Cook Islands literally partnered with elite American asset protection attorneys to aggressively rewrite their local trust legislation. They deliberately authored their sovereign laws to specifically repel the exact legal attacks, forensic accounting maneuvers, and equitable distribution mandates utilized by American divorce attorneys. The most devastating legal mechanism these offshore jurisdictions employ is the absolute non-recognition of foreign judgments. If a family court judge in California or New York issues a binding legal order demanding that a spouse surrender 50% of their accumulated wealth, that meticulously drafted piece of paper is completely worthless in the Cook Islands. The foreign trustee, a highly regulated financial institution physically located on the island, is legally prohibited by their own sovereign law from complying with the American court order. For the pursuing spouse to access that capital, they are forced to travel to the offshore jurisdiction, hire specialized local attorneys who legally cannot take the case on a contingency fee basis, and essentially retry the entire divorce settlement under foreign laws heavily skewed in favor of protecting the trust apparatus. Furthermore, offshore jurisdictions utilize an aggressive statute of limitations. While an American court might allow a spouse to attack a financial transfer made a decade ago, the Cook Islands generally demands that any lawsuit alleging a fraudulent transfer must be filed within 1 or 2 years of the capital moving offshore. By the time a marriage begins to fundamentally fracture, the legal window to attack the safety net has completely expired, rendering the assets legally untouchable. To fully understand the sheer mechanical power of this strategy, we must examine a specific contractual mechanism built into every offshore trust known as the duress clause. Imagine a highly lucrative software developer named Jonathan, living in San Francisco in the year 2026. Jonathan successfully exited his technology startup and proactively placed $30 million of liquid capital into a Cook Islands trust 3 full years before he ever met his future wife. When the marriage inevitably fractures and the dissolution process begins, the California judge, infuriated by the offshore structure and the inability to access the capital for equitable distribution, looks directly at Jonathan and orders him to repatriate the funds immediately. The judge legally threatens Jonathan with civil contempt of court and indefinite incarceration if he refuses to bring the $30 million back to the United States jurisdiction. Jonathan fully complies with the judge. He formally writes a letter to his trustee in the Cook Islands, demanding the immediate release and repatriation of the entire $30 million. However, the trustee reads the letter and immediately activates the duress clause. The foreign trustee legally determines that Jonathan is not making this financial request freely or voluntarily. He is making it under the extreme coercion and direct threat of a United States judge. Because Jonathan is legally categorized as being under duress, the trustee is contractually obligated to step in, legally strip Jonathan of all his discretionary beneficiary rights, and flatly deny the transfer request. Jonathan then turns back to the California judge and presents the formal denial letter from the foreign bank. He successfully utilizes a powerful legal defense known as the impossibility of performance. He demonstrates to the court with documented proof that he legitimately tried to retrieve the capital, but he simply does not possess the legal power or authority to force the sovereign foreign trustee to release it. Because the United States legal system cannot legally incarcerate an individual for failing to perform a completely impossible act, Jonathan retains his physical freedom, and the $30 million remains perfectly protected and compounding within the offshore fortress. While the potential outcomes of this strategy are undeniably effective at protecting capital, the Offshore Asset Protection Trust represents a financial safety net exclusively reserved for the ultra-high net worth demographic. The economic friction and administrative burden required to establish and maintain these international structures are staggering. You must pay massive upfront legal retainers to specialized international attorneys, significant and recurring annual maintenance fees to the foreign institutional trustees, and endure brutal, ongoing tax compliance audits from the Internal Revenue Service. Mechanisms like the Foreign Account Tax Compliance Act and heavily penalized foreign bank account reporting requirements make the maintenance of offshore wealth an incredibly stressful endeavor. Historical trends in wealth management data consistently demonstrate that utilizing an offshore trust for a net worth under $5 to $10 million is mathematically irrational due to the crushing administrative overhead, entirely wiping out the yield of the protected capital. This strict financial barrier to entry created a profound systemic vacuum within the American financial landscape. By 2026, the elite tier of society possessed impenetrable legal vaults located in the South Pacific, completely shielding their multi-generational wealth from the volatility of the family court system. Massive multinational corporations possessed heavily structured liability policies to protect their workforce productivity from the distraction of legal dissolution. But the vast majority of the American public, the successful small business owners, the dual-income medical professionals, the individuals possessing a net worth between $500,000 and $5 million, were left entirely exposed to the chaotic, wealth-destroying machine of equitable distribution, subjective judicial rulings, and exorbitant legal fees. They were too wealthy to qualify for legal aid, yet not wealthy enough to justify the extreme costs of offshore financial privatization. Financial engineers, sophisticated actuaries, and quantitative analysts operating within the institutional risk markets observed this massive, entirely unaddressed demographic and recognized the greatest untapped economic opportunity of the 21st century. They understood perfectly that the American middle and upper middle class could not afford offshore sovereign trusts, and they could not rely on the inherently fragile, easily invalidated structure of domestic prenuptial agreements. The market demanded a highly scalable, mathematically pure financial derivative that functioned exactly like a powerful insurance policy, but entirely circumvented the massive regulatory bloodbaths, the state insurance commissioner blockades, and the intense moral hazard debates that plagued the early pioneers of the divorce insurance industry. The solution required completely abandoning the subjective, highly litigated, and emotionally charged realm of family law, and embracing the cold, undeniable precision of algorithmic finance. Instead of attempting to ensure the emotional collapse of a marriage and heavily auditing the subsequent legal expenses, Wall Street quants began to theorize a product that triggered a liquid financial payout based strictly on verifiable, third-party public data. They envisioned a derivative contract that functioned entirely independently of any courtroom drama, completely eliminating the need for expensive forensic accountants, aggressive litigators, and subjective state insurance adjusters. They looked toward a massive innovation already disrupting the agricultural and catastrophic weather insurance markets, an innovation that was about to be weaponized to protect the American marital estate. This conceptual breakthrough paved the way for the most sophisticated, highly controversial, and profoundly revolutionary financial safety net ever introduced to the United States public. A highly engineered system designed to automatically deploy liquid capital the exact moment a legal dissolution decree is publicly filed, utilizing decentralized verification networks and rigid algorithmic triggers that completely bypass the traditional, legacy insurance industry. But executing this masterstroke of financial engineering required leveraging entirely new technological frameworks and aggressively exploiting massive loopholes in traditional derivative regulations, setting the stage for a dramatic, unprecedented showdown between the rapidly evolving world of decentralized finance and the deeply entrenched, traditional legal order. To execute this monumental pivot, financial engineers turned away from the analog world of human insurance adjusters, subjective policy limits, and bureaucratic delays, and fully embraced a highly complex concept known as parametric insurance. Historically, parametric systems were exclusively utilized by massive agricultural conglomerates to protect against catastrophic weather events. Instead of sending an inspector to a farm to calculate the exact dollar amount of crop damage after a severe drought, A parametric policy simply pays out automatically if a satellite records that localized rainfall dropped below a highly specific mathematical threshold. The entire system operates on a binary, completely emotionless trigger. The brilliant architects of modern marital safety nets realized that the legal dissolution of a household produces a similarly verifiable, universally recognized, and publicly recorded data point. That data point is the official, stamped filing of a legal divorce decree with the county clerk. By linking a sophisticated financial derivative directly to this irrefutable public record, they entirely eliminated the need for human intervention, effectively creating a financial safety net that operates with absolute mathematical certainty. Enter the architecture of decentralized finance and the deployment of self-executing smart contracts operating on global blockchain networks in the year 2026. A smart contract is not a legal document drafted by an attorney. It is a rigid, immutable piece of computer code that securely holds liquid capital in a digital escrow. The code is programmed with absolute, unyielding logic. If event A is verified, then immediately execute transaction B. There is no tedious appeals process. There is no subjective human evaluation. To reliably feed real-world data into this isolated computer code, software developers utilize decentralized oracles, which are highly secure, automated digital bridges that continuously scan and verify public municipal court databases across the entire United States. Consider a highly realistic case study involving a dual-income professional couple, David and Jessica, currently living in suburban Ohio. They recognize their immense financial exposure, but they simply do not possess the required minimum liquid capital to establish an elite offshore sovereign trust in the Cook Islands, and they adamantly refuse to endure the adversarial, relationship-destroying tension of negotiating a traditional prenuptial agreement. Instead, they mutually agree to fund a decentralized parametric marital liquidity pool. They deposit $50,000 in algorithmic stablecoins, which are specific digital assets pegged directly to the United States dollar to entirely avoid the extreme price volatility of standard cryptocurrency, into a highly audited smart contract. The parameters governing this specific contract are brutally simple and flawlessly transparent. The decentralized Oracle network continuously monitors the precise county court digital database in Ohio where David and Jessica hold their legal residence. If the Oracle successfully detects a verified, digitized divorce decree matching their exact legal identities and social security profiles, the smart contract instantaneously shatters. Within 3 seconds, completely bypassing restricted banking hours, holiday weekends, and any potential legal injunctions, exactly $25,000 is autonomously routed to David's private digital wallet, and the remaining $25,000 is routed directly to Jessica's wallet. The potential outcomes of this algorithmic mechanism represent a massive paradigm shift in personal asset protection. Because the capital transfer is entirely mathematically automated on a decentralized network, it physically cannot be frozen, seized, or delayed by a hostile family court judge, issuing a punitive temporary restraining order on their traditional fiat bank accounts. Because there is no corporate insurance underwriter actively evaluating a subjective claim, there is absolutely zero risk of the financial payout being denied on a hidden technicality or a missed premium payment. Because the capital arrives instantly upon the initial legal filing, both David and Jessica immediately possess the critical, highly liquid financial ammunition required to retain competent independent legal counsel, secure immediate separate housing, and maintain their daily living expenses. They completely avoid the catastrophic, high-interest debt spiral that typically destroys the economic foundation of the American middle class during the chaotic initial shockwave of a household separation. This architecture does not offer traditional indemnification against loss. It provides guaranteed, instant liquidity injected at the precise millisecond of maximum financial vulnerability. However, the moment these decentralized parametric contracts began gaining massive viral traction among the American public, the traditional regulatory establishment recognized a lethal, existential threat to their institutional control over domestic wealth. The ensuing conflict created a regulatory bloodbath that completely dwarfed the early lobbying struggles of the corporate insurance pioneers. State insurance commissioners, suddenly realizing they possessed absolutely zero legal jurisdiction over anonymous computer code executing on a distributed global network, panicked on an unprecedented scale. They desperately petitioned massive federal agencies, specifically the Securities and Exchange Commission and the Commodity Futures Trading Commission, demanding aggressive, immediate federal intervention. The legal argument deployed by the federal government to attack this technology was fascinating and deeply controversial. Regulators argued vehemently that these parametric marital contracts were not actually insurance products or legitimate safety nets at all. They officially categorized them as unregulated, highly illegal binary options contracts. The government asserted that American citizens were essentially engaging in synthetic derivatives trading, placing complex, unregistered financial bets on the statistical failure of their own legal unions. This severe regulatory classification triggered an unprecedented, multi-billion-dollar legal war between technologists and the state. Decentralized finance developers argued fiercely in federal court that shutting down open source code was a fundamental violation of free speech and personal financial sovereignty. They presented extensive historical trends demonstrating that traditional financial institutions and the legacy legal system had completely abandoned the middle class, leaving algorithmic liquidity as the only mathematically viable, affordable safety net available to average citizens. They argued that preventing two consenting adults from voluntarily locking their own capital into an automated escrow protocol was a massive, unconstitutional overreach of federal authority. But the traditional legal order, absolutely terrified of losing their deeply entrenched ability to legally control, litigate, and heavily tax the distribution of marital assets, began aggressively targeting the centralized infrastructure. They utilized intense federal pressure to force major domestic banks to permanently block any wire transfers or debit card transactions associated with these specific parametric platforms, attempting to aggressively starve the smart contracts of their initial funding mechanisms. This brings us to the absolute bleeding edge of asset protection in the modern economic era. Throughout this comprehensive masterclass, we have traced an incredible, highly volatile historical arc. We witnessed the traditional agricultural family unit fundamentally dissolve into highly liquid, easily divided capital. We watched the early, highly destructive legal mechanism of permanent alimony collapse into the chaotic, deeply subjective system of equitable distribution. We meticulously observed the massive structural vulnerabilities of prenuptial agreements and the heavily compromised, employer-tethered corporate legal insurance policies. We explored the impenetrable, highly exclusive elite fortresses of offshore sovereign trusts. And finally, we arrived at the violent algorithmic frontier, where raw mathematics and cryptography are actively attempting to replace human fiduciaries and family court judges entirely. The fundamental truth revealed by this exhaustive historical timeline is that the architecture of personal wealth preservation is never static. The legal mechanisms intentionally designed to access and divide your assets are constantly evolving, becoming significantly more sophisticated, highly aggressive, and deeply invasive with each passing decade. But as the federal government actively prepares a massive, highly coordinated legislative strike aimed at permanently outlawing these decentralized safety nets, a completely new, deeply terrifying financial variable is quietly entering the equation. While millions of individuals are focusing entirely their energy on protecting their assets from their spouses, they are completely ignoring a massive, silent demographic shift that threatens to instantly liquidate their entire net worth before they ever even reach a courtroom. A systemic, highly complex legal vulnerability that directly targets the very foundation of the American housing market and leaves even the most carefully constructed offshore safety nets utterly defenseless. So, how exactly are aggressive new legislative frameworks weaponizing long-term care mandates to completely drain the accumulated wealth of the modern household? And what radical, highly controversial steps are the ultra-wealthy taking right now to hide their real estate equity from the federal government?